In today's video, we are going to discuss two business owners who recently started some relatively large whole life insurance policies. You'll notice that the annual funding is 7 figures. Now, as we progress through today's video, we'll discuss why they were interested in whole life insurance. But then we'll look at the different companies and products they were interested in. And lastly, we'll look at how they plan to use the policies, specifically referring to the loan feature, and they plan on using the policies both for business and personal use. So let's get on into it and have some fun. We had a lot of fun with this case study because it is based on an actual case. So I had connected with these two December of 2022. They were interested in whole life insurance, and they were interested primarily in the cash value for the core benefits being a safe, liquid, and tax-free area to position money. Tax-free if we do not trigger a taxable event. One taxable event is a modified endowment contract. We've got information on other taxable events in our whole life taxes video, which you'll see up top. But their primary focus here is the cash value. They want to be able to heavily fund the policy. You'll see that the annual funding is $2 million. The first year is actually a little bit more than that. You'll see that when we pull up the numbers, it's about $2.2 million in the first year. And this is broken up among 4 different whole life insurance policies, 2 policies on each business owner. So points of interest here. Number 1, accessing the cash value for opportunities, and that is both personal and business opportunities. Now, what I'll say about these two is that they move faster than almost anyone I've ever met. With respect to business and response time, they run a company that is fairly large. It generates 8 figures in annual revenue, so they've got a lot going on. Anytime we request information, even if it's sensitive, or anytime we reach out in general, the speed in which they get back is fascinating to me. I've shared it with a couple people I work with. I'm like, I don't know how they get back so fast on a consistent basis, but it's commendable how they're able to respond so quickly. Now, that leads into my next point. On my first call with them, they had expressed frustration with banks in the past, and that was due to past experiences. But one thing about banks, when you own a business, if you have a time-sensitive issue, does the bank always come through and make sure that you receive your funds on time when you own a business? Or maybe you're investing in real estate? No. There's times it's not going to happen. Due to banking regulations and such, they're going to stick to their process. So that can be frustrating, especially if you operate a business at a very, very fast pace and time is money, like we got to move quickly. The bank can't deliver. Sometimes people say, fine, I'll build up enough capital so I can do things on my own. So that's really their plan in this particular case. What they want to do is build up cash value and then use that cash value as a line of credit, in a sense, replace the need to rely on banks for financing. So in a case like this, what I'll add is that it's very important to review the loan interest. What we like to look at, and we're going to look at a model toward the end of this video that demonstrates this, is how's the policy performing? Meaning when I pay money in and I look at that cash value grow, what's the growth look like on a yearly basis, and what's the growth look like over time? That's fun to look at to see exactly how the cash value is performing. But when I look to leverage the policy, specifically taking out policy loans, how much am I paying in loan interest? And then I can see it on a yearly basis. I can see exactly what I'm paying in loan interest compared to what my policy is growing by. And what business owners like to see is that they are not in the red, meaning the growth is exceeding the loan interest. If I can see those numbers side by side, it gives me the information I need before making that decision. Very, very helpful there, and it's important to review that. So really, what that comes down to is what is the cost of the loan compared to the cash value growth or the gains. Now, they also had an interest in cash value, just looking at the growth, and then death benefit protection as well, as this is a big benefit for them since they operate a company that has 8 figures in annual revenue. They are the 2 owners. So if anything happened to them, that's going to really cause financial pain for the company. So the death benefit protection is a huge advantage there. Company selection. We discussed a number of companies. We narrowed things down to MassMutual and Guardian and looked at a variety of products with each company. What it came down to ultimately, though, was premium flexibility and the funding period. This helped narrow down the decision. What they decided on was Guardian. And a big reason why was premium flexibility. So the funding period right now is 10 years. So if they follow through with funding the policy at $2 million per year for 10 years, how much money goes into the policy? $20 million. And that's just their payment. The total cash value will be more than that. So that's a lot of cash to pump into whole life insurance policies. So let me ask this. If you generate 8 figures in annual revenue, how comfortable would you be committing to $2 million per year? Some business owners are comfortable with that. Some aren't. Even if they have the means to fund the policy, they look at it and say, you know what? I don't think that it's going to be an issue. It's all relative based on your situation. But in this particular case, pretend this is you. I don't think the $2 million is going to be an issue. However, there are times that our cash reserves might be a little bit lower if we have to have cash out in the marketplace. So premium flexibility is very important here. And this is really what made Guardian advantageous in this particular case. That, with the combination of funding the policy for 10 years in this particular situation. So when we look at the policy details, if I want to do this, I want to fund a policy with $2 million per year. Here we go. What Guardian will allow is for me to commit to the minimum. So the minimum here, the premium commitment, which includes the base premium and also the term insurance rider. This is what the business owners will be billed for every year. And they are electing to pay the premiums annually, is about $230,000. Meaning this is their commitment, but they have the ability to add up to $2 million per year, and everything above that minimum commitment, their PUA rider, which stands for paid up additions, those can be added at leisure. So this creates a very flexible policy. And what I'll also add is that you do not need $2 million to do this. A lot of individuals who are funding policies up to $100,000 per year will do the exact same thing, where they'll commit to, call it $10,000 per year, and then add up to $100,000 per year. In this case, it's up to a total of $2 million, and you'll notice the minimum is a little bit higher than $200,000, just with the term riders and such. And what I'll also add is when we look at the ages of these individuals, got 2 business owners, both females, ages 40 and 54. When starting the policies, that is. Okay. So, goals here with the policies. Number 1, maximize the cash value and flexibility. This is something we always talk about. If cash value is your goal, maximizing it first gives you as much money as possible. This way, if you plan on using the policy for whatever it might be, let's say you plan on borrowing and repaying or taking an income stream down the road, if you've maximized the cash value, you've got more money to work with. So that's goal number 1. We'll go through that. And then goal number 2 is using the policy, specifically through loans. Now, when starting, these will be personal policies, meaning personally owned, but used for business. And ownership may later be set up as a trust or transferred to a trust. As in a case like this with larger policies, we do recommend involving an estate and or tax planning attorney because there's a lot more that goes into it. We're going to focus on the design and maximizing the cash value. That's what we do. But when we layer a plan like this, there's a lot more items that need to be considered. So here we go. Here are the combined values. We've got 4 policies here, which I'm going to go through each of them individually in a minute. But combined values, year 1, minimum commitment, just under $230,000, $229,000. The first year payment is what? Not $2 million, $2.2 million. So total payments in the first year, 2.2. What's your cash value? Almost $2 million. So that's less than the 10% hit when you look at it. However, that's still $200,000. It's a little bit more. What's the worst year of any whole life insurance product, no matter how well it's designed? meaning no matter how low that premium, how low the expenses, the commissions, everything are driven down, the first year will still be the worst year, meaning I get less back than what I paid in. However, if I look at the next year, what happens? My annual outlay is $2 million. This includes the minimum commitment. My cash value the year prior was 1,987. Now it's 3,977. Did I get my full $2 million back? Just about. Not quite all of it in this particular case. However, year 3, I do get my full $2 million payment back. And what's highlighted in yellow down here is my break-even point. Meaning, when I look at my total payments, my total cash value has now exceeded my total payments. So dividend values is based on the company's present dividend interest rate, 5.75%. What I'll add is in a case like this, showing more than just the dividend values is important. And what I'll say is if you're in the business, if you're an agent and you've got a potential client looking at some larger policies, if you don't show the guaranteed values and conservative scenarios, a third-party advisor will likely be brought in at some point, or maybe your potential client is already working with a third-party advisor, and the guaranteed values will likely be requested. So what I would always do is show the guaranteed values, show some of the worst-case scenarios, or all of them. This way, you're being upfront about everything. This is something I always like to do because what it provides is, here's what a worst case scenario looks like, which allows individuals to set expectations in a conservative manner. So when I look at the guaranteed values, this is the exact same product, by the way, same funding, 10 years, total of $20 million into the product. And what do we notice here? Cash value performance, breaks even, between years 8 and 9. Sizable death benefit, initially over $60 million, but that's a combination of 4 policies. I'm going to show you the breakdown in a minute. On the right, we've got the same policy, but with an indexed rider demonstrated. This assumes the cash value is tied to the S&P 500 index, which means if the market goes up, their cash value goes up with it. If the market goes down, their principal is protected, and they still receive the guaranteed rate on their whole life product. Not everybody likes this, but the fun part is you can switch back and forth between that and the dividend over the years. You could even go 50% dividend, 50% index. It's a nice option that provides flexibility. So we've got some different assumptions here regarding the product, or products, I should say. But let's take a look at this. So this displays a breakdown of the 4 policies in which the $2 million per year was allocated toward the products. So here's what we've got. 2 policies on the age 40 partner, and then 2 policies on the age 54 partner. We've got a preferred rating over here and a standard non-smoker rating over here. Now, what I'll add about this is the actual products and the actual funding differed a little bit from what we see up here, but this displays one of the proposals we had shown them, which has the total dollar amount that they'd like to get into the policy, but broken up among 2 policies on each of them. But as we look at this, what do you notice? You'll see the minimum commitments here, $27K per year. You can start off in the first year with an excess payment of $450,000. Break-even point, year 4. That's when the cash value is equal to or greater than the total payments. Here we go, $1 million per year, minimum commitment, $120,000. That includes the base premium and the term rider. First year, almost 92%. Break-even point, not year 4, between years 4 and 5 in this particular case. Then these 2 policies, clean break-even of year 4. Minimum commitments, 27 and 55. So if we go back to the combined values, remember what that minimum commitment was? About $229,000 and a total annual outlay of $1 million. Quick reminder, looking at the combined values, The minimum commitment is what they're billed for each year. The annual outlay displays the total desired payment. In reality, they might fund a different amount than that $2 million per year. And that can vary. That's a big reason we set policies up to be flexible. This way people do not feel like the policy is a burden. So let's take a look at one more report here based on the present dividend rate. And this is something that is beneficial to look at. So what this displays is additional reports that display the net internal rate of return. So this is what the policy is growing by annually. Then the annual cash value growth and the total gain on cash value. So if we look at this guy, year one, I pay in $2.2 million. I've got just under $2 million, which comes out to a return of negative 9.65%. No matter how I slice it, that's the actual internal rate of return that year. Year two, I pay in $2 million. Cash value was 1987. Now it's 3977, which means I almost got my full $2 million back. But if I got the full amount back, that would be 0%. It's a negative 0.25% because I do not get the full amount back. Year three, $2 million goes in. I get my $2 million back and a little bit more, which is why my internal rate of return is just about 1% that year, which that 1% comes out to over $57,000 in growth because I've got a big old bucket of cash value in there. So each year, you'll see that IRR continue to pick up the pace. Annual cash value growth. A lot of times people will prefer this. It just shows what I'm receiving each year from the insurance company in total growth. And then in purple, we've got the total gain. And what you'll notice here is I'm negative until I see the yellow highlighting over here. So once the policy breaks even, I see a gain on cash value, meaning I've got more money in cash value than what I paid in. So for example, year 10, I've paid in a total of $20 million in change. I've got $23 million in change. So the difference is the gain. So this helps just to measure the actual cash value growth on a yearly basis. And you can receive all of these reports in the detailed illustrations as well, which in a case like this, what we do actually is walk through the detailed illustrations. So here's one of them with the $1 million per year for 10 years on the 40-year-old individual. There's my base premium at 100K. Voila, cash value looks great. We look at the 54-year-old individual, 500K per year, different product here. Base premium, 45,000 and change. Got a term insurance rider. What we did was round things up. So the minimum commitment is about 55K per year. And then they can add up to a total of 500,000 per year for 10 years in this particular case. So the detailed illustrations are helpful, but let's wrap this up and take a look at the loan scenarios because we focused on the payment flexibility, the cash value growth, what it looks like year over year, and how to juice the cash value so I can really use it over time. But we haven't looked at actually using it. So what we'll look at in a case like this is our loan workbook. We'll definitely run actual loan scenarios as well. So we'll provide illustrations that display loans in the life insurance company software. This is just a quick workbook that allows individuals to get a rough idea of what loans will look like. So this is a quick loan workbook. It does not model direct policy loans, but it is pretty cool because I can see what the policy is growing by and compare that with what I'm paying in loan interest. So policy values, here we go. Combined values on the left, cash value, death benefit, IRR, yearly cash value growth, and total gain on cash value. That's what we just looked at. So when we look at loans, here we go. LTV, loan to value at 95% of cash value. So if you have a whole life insurance policy, typically the maximum loan you can take is going to be about 95% of your cash value. Some companies allow a little bit higher, some you'll see a little bit lower, but if you approach it, that 95% range, you'll generally see it fall right around that figure. So what we've got here is year one, my cash value is 1987. 95% of that is this figure here, 1.88 million. So if they want to access the cash value here, let's say I'm going to take a policy loan. Let's do it in year 4. We can do it anytime we want, but I'll show you where I'm going here. Got 7.7 million, almost 7.8 in available equity. Let's take a loan, and let's say it's for $4 million. We'll take a large business loan in this case. So if I take a $4 million policy loan, this is me. Here's what I want to see. There's the $4 million loan. Cost to borrow in this case is 5%, which with their Guardian products, they have a fixed loan interest rate of 5%. If they pay the interest annually, it's going to come out to 4.76. Now, Guardian's also a direct recognition company, so I would definitely want to run this model in the illustration software so we can see exactly the impact it has on their cash value performance and make sure that that's disclosed. But just for this model, so I can see what it looks like, a $4 million loan. There's the interest rate, annual interest payment. Okay. Far right, comparison. I don't like that color. It's red underneath. Let's go blue. All right. Yearly cash value growth. I can see each year what the policy is growing by. All right, that's great. When I look at year 4, when I took that $4 million, what do I see here? $4 million loan is outstanding. Annual interest payment, $190,000. Yearly cash value growth, about $150,000. I'm behind about $40,000. Now, if I pay interest only and I do not make any loan payments here, what happens the next year? Well, loan interest payment, $190,000. Yearly cash value growth, $246,000. Now all of a sudden I'm ahead. I'm ahead $56,000. The reason why that happened is not due to the rate, because if I look at the interest rate here, it's 4.76%, yet the IRR is 2.42%. You know why you're ahead? Because that 2.42% is on your total cash value. You're at $10 million plus in year 5. So 2.42, $10 million of cash value will produce more money or greater dollar amount than 4.76% on $4 million. So there's a lot going on there, but to simplify, what has been helpful for a lot of individuals is being able to see this side by side. It's the actual growth compared to the actual interest paid each year. And then if I want to look at total dollar amounts, I can look at my total gain on cash value compared to the total interest payments. So let's wrap this guy up by taking a look at paying it down. So why don't we do this? We'll assume interest-only payments. You know what? Let's take out another $4 million loan. Year 7. We'll also do one in year 10. We've got $12 million in loans outstanding. But now we're no longer funding the policy. We are paying loan interest over here, almost $600,000 per year. So why don't we do this? We'll assume we begin to repay the loan at $1 million per year. And we can pay it back however we want. But what this demonstrates is taking loans, repaying them, and then simply seeing what am I paying in interest each year, compare that with what the policy is growing by, and then look at the total gain on cash value compared to the total interest paid. I hope you enjoyed this case study. I had a ton of fun with it because we got to break down exactly what they are interested in, how to maximize the cash value, and then how they plan on using the cash value. If you did enjoy it, please hit the like button, subscribe for more. If you have any questions or comments, please leave them below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.